The possession as well as the ownership of the goods passes from the seller to the buyer immediately. So this is the main difference between hire purchase system as well as installment system. So whatever the amount which is deducted from debtors, it is always considered as liabilities. Why written agreement is more preferable than oral agreement? Because this written agreement always acts as a evidence. Hello everyone, I am Arshita, lecturer, Department of Commerce, Vidhyaashram First Grade College, the Temple of Excellence, MYSURU. My dear students, today we are in the revision 2 of Unit 4 to 6. So my dear students, in revision 1 we have discussed from Unit 1 to 3. Today we are going to discuss from Unit 4 to 6 of Financial Accounting 2, and this is for second sem B.B.A students. So my dear students, your Unit 1 was about joint venture, Unit 2 branch accounts, and Unit 3 hire purchase system. So in today's session we are going to discuss from Unit 4 to Unit 6. So your Unit 4 is about installment system, Unit 5 partnership accounts, and Unit 6 dissolution of partnership form. Hope you have gone through the sessions. Now we shall revise those units, that is from Unit 4 to Unit 6. Now we shall go through the Unit 4, that is installment system. Now what do you mean by installment system? Here the possession as well as the ownership of the goods will be transferred immediately. So for example, I'll give an example here. For example, there are two parties A and B. Now A is the owner of the asset and B is in need of asset. So what A will do, as I told, A is the owner of the asset. So A will transfer the assets to B, where B is not going to make the payment in full. On the date of agreement, so there is an agreement between A and B. On the date of agreement, that is on the date of transfer of goods, B will pay certain percentage of the total cash price. For example, if the asset is vehicle and the total cash price of the vehicle is 3 lakh. Now here, on the date of transfer of the goods, B will not make the payment. That is whole 3 lakh he will not make the payment. He will pay, for example, he will pay worth rupees 1 lakh. So this 1 lakh is paid on the date of transfer of the goods, which is called as down payment. Now what is this 1 lakh? So 1 lakh is down payment. Remaining 2 lakh will be paid by B to A in the form of installment. That is, along with interest, along with principal plus interest, he is going to make the installment. So this is about what? Installment system. So you might wonder, so hire purchase system also the same procedure, right? But here the difference is that on the date of agreement itself, the ownership will transfer. Whereas in hire purchase system, the ownership will be transferred only after the payment of last installment. But here the ownership will be transferred immediately on the date of agreement itself. So this is about installment system. You can expect a 10 marks problem on ledger accounts, that is on installment system. And if you learn hire purchase system, same will be the installment system also. Okay. Now go through the meaning of installment system. The possession as well as the ownership of the goods passes from the seller to the buyer immediately. So this is the main difference between hire purchase system as well as installment system. On entering the agreement, but the buyer agrees to pay the total price in what? In installment. So here the payment will be made in installment. So here the buyer will pay only certain percentage of the amount on the date of agreement or on the date of transfer of the goods. Remaining amount will be paid in the form of installment. It is called as installment purchase system. Hope you are clear with the meaning of installment purchase system. Now let us see what is the difference between hire purchase system and installment purchase system. Now I have already told you one of the difference. Let us see quickly what are the difference between hire purchase system as well as installment system, and this is a very important 10 marks question. Now go through here. Hire purchase system, it is the agreement of hiring. Hire purchase system is the agreement of hiring, whereas installment system is the agreement of sale. So installment system is agreement of sale, whereas hire purchase system is the agreement of hiring. The next difference is that it is governed by Hire Purchase Act of 1972, whereas installment system, it is not governed by any of the act. So here hire purchase system is governed by Hire Purchase Act of 1972, whereas installment system, it is not governed by any of the act. Next is the parties to the contract or agreement is called as hire vendor as well as hire purchaser. So here the parties under hire purchase system is hire vendor as well as hire purchaser. Whereas here installment system, it is just buyer and the seller. The parties is who? Buyer as well as seller. Now if you see about ownership, so ownership of the goods is transferred only after the payment of last installment. So here under hire purchase system, we have already discussed the ownership will be transferred only after the last installment. Whereas coming to hire purchase system, so it is transferred immediately on the date of agreement itself. So here the ownership will be transferred immediately on the date of agreement. Next is, in case of default, hire purchaser can take back the possession. Suppose if the hire purchaser, so you know here the parties are hire purchaser as well as hire seller, right? So if the hire purchaser have not paid any of the installment, then hire seller has a right to take back that goods under hire purchase system. But in installment system, he cannot take back the possession, but he can sue for the payment. So here under installment system, if any of the installment is not paid by the buyer, in such cases, under installment system, the goods cannot be taken back. Say, they can sue in the court of law. The relation is that of bailor and bailee. So under hire purchase system, the relation is that of bailor and bailee, whereas in installment system, there is no such relationship. So there is no relationship under installment system. Next, under hire purchaser can terminate the contract, but he cannot claim the amount paid. So here under hire purchase system, they can terminate the contract. They can close the contract, but whatever the amount is paid, that cannot be taken back. Whereas here the buyer cannot terminate the contract. So these are the main difference between hire purchase system as well as installment system. And I have told you this is a 10 marks question where they will ask difference between hire purchase as well as installment system. Now we shall go through the next unit, that is partnership accounts, where you are going to learn about admission of a partner, retirement of a partner and death of a partner. Now if you go through the admission of a partner, now what do you mean by admission of a partner? If a new partner enters into an existing partnership firm, is called as admission of a partner. So admission of a new partner is the inclusion of new partner. For example, if there are two partners A and B, now, a new partner wants to enter the partnership firm, that is C. Now, the arrival of new partner to the existing partnership firm is called as admission of a partner. So, admission of a partner is the inclusion of new partner as an associate or partner to an existing partnership firm is called as admission of a partner. So, if a new partner enters into an existing partnership firm, it is called as what? Admission of a partner. Now we shall go through a 15 marks problem on admission of a partner. Very easy problem. We had already solved many problems relating to this unit. Now go through the problem here. The following is a balance sheet of Raga, Thala, who share profit and loss in the ratio 2:1. Now what they have given? There are two partners, Raga and Thala. What is their profit sharing ratio? 2:1. That is 2/3 and 1/3. So this 2:1 can be written as 2/3 and 1/3. Next, what they have given? They have given the balance sheet before the admission of a new partner. Now go through the balance sheet here. They have given creditors 78,800. Next, loan 43,000. General reserve 42,000. Profit and loss account 18,000. Next, they have given capital of both the partner, that is Raga 1,20,000 and Thala 80,000. So the total is 2 lakh. Now coming to the asset side, we have cash at bank 19,800, debtors 22,000, stock 60,000, machinery 70,000 10,000, land and building 2,10,000. And the total of both the side is 3,81,800. So this is a balance sheet which is given before the admission of a new partner. Now go through the adjustment here. Shruti is admitted into partnership. Now, who is a new partner here? Shruti is a new partner. She is admitted into partnership on 1st April 2017 on the following terms. Let us see what are the conditions on which the new partner has been admitted. She has to bring 80,000 as capital and 42,000 as goodwill. Now, what the new partner will bring? During the admission of a new partner will bring certain amount as capital. Other than capital, she will bring some extra amount which is called as goodwill or premium for goodwill. Now, why this goodwill is bought by the new partner? In order to distribute to the old partners in sacrifice ratio. Now, why that amount has to be given to the old partners? Because during the admission of a new partner, old partner has sacrificed their share of profit in favor of new partner. For that reason, if the new partner admits into a partnership firm, he or she has to bring certain amount as goodwill, and that goodwill will be distributed among the old partner as a compensation for the share sacrificed by them. Now here also Shruti has bought 80,000 as capital and 42,000 as goodwill. Next adjustment is that a reserve of 6% is to be created on debtors. Now, what do you mean by reserve? So, whatever which is deducted from debtors. So, whatever the amount which is deducted from debtors, it is always considered as liability. So, what it is? It is a liability. Now, a reserve has to be created on debtors. Now, if you see the balance sheet, they have not deducted the reserve. In the sense, in the adjustment, they are telling that on the admission of a new partner, a new reserve have been created. To what extent? At 6%. So, we have to deduct that reserve. So, it's nothing but increase in liability, because reserve is a liability. In the balance sheet, they have not given that liability, but they are telling now to create a reserve. In the sense, liability increases. Next, machinery is depreciated by 5% and stock by 4%. In the sense what? Depreciation means what? Decrease in the value. So, decrease in the value of asset, that is machinery as well as stock. So, what do you mean by that? So, decrease in asset. Clear? Land and building appreciated by 10%. So, land and building is an asset. Appreciation means increase. So, increase in asset. Next, outstanding audit fees. So, outstanding audit fees is what? It's a liability. Whereas, if you see the balance sheet here, they have not given outstanding audit fees. In the sense, earlier it was not there. Now, there is outstanding liability. So, what does it mean? Increase in liability. So, outstanding audit fees, it's a liability. Whereas, in the balance sheet, they have not given outstanding audit fees. In the sense, on the date of admission of a partner, liability have increased. To what extent? By rupees 1,000. Now, increase in liability. Now, all these increase or decrease in assets and liability, where will we record? In the revaluation account. So, we have already learnt about it. So, this has to be recorded in revaluation account. Okay, next they have asked us to prepare ledger accounts and balance sheet of the new firm. Hope you know which are the accounts to be prepared. Revaluation account, partners capital account and bank account. And which is a statement we have to prepare, that is a balance sheet. Now we shall go through the solution. First we shall prepare the revaluation account. Now what do you mean by revaluation account? It is an account where we are going to record increase or decrease in the value of assets and liability, and to what extent the assets and liability have increased or decreased. So after recording increase or decrease in the value of assets and liability, so the balancing figure will be either revaluation profit or revaluation loss that has to be distributed among the partners, that is only the old partners. In which ratio? Old ratio. Now what you are going to record in the debit side? So that is A minus L plus. I had given you an hint that in the debit side you have to record A minus L plus, in the sense if any assets have decreased and liability have increased, you are going to record in the debit side. Whereas in the credit side, A plus L minus. So if any assets have increased and liability have decreased, you are going to record in the credit side. Now go through the adjustment one by one. So no need of this first adjustment. So we are going to record about capital and goodwill in partners capital account. Now see the second adjustment, that is increase in liability. We have already identified. So where do we record increase in liability? In the debit side. So how to record? To reserve on debtors. Now see what is the debtors? Debtors is 22,000. What is the percentage? 6%. So 22,000 into 6% you will get 1,320. In the same way, next one is what? Machinery and stock is being depreciated. So decrease in asset. So we have identified, right? So it is what? Decrease in asset. So where do we record decrease in asset? That is in the debit side. So how to record? To machinery account. So which are the asset which has been decreased? Machinery and stock. So first we shall record to machinery account. So to what extent it has decreased? It has decreased by 5%. Now see the balance sheet. The machinery value is 70,000. 70,000 into 5%. So how much you'll get? 3,500. Next is stock is decreased by 4%. Now what is the value of stock? 60,000. Decrease in asset, where do we record? Debit side. So it is been decreased by 4%. So to stock 60,000 into 4 divided by 100, you'll get 2,400. Next one is land and building appreciated. In the sense increase in asset. So where do we record increase in asset? A plus. Right? So by land and building, to what extent it has increased? It has increased by 10%. So land and building, 2,10,000 is the value. So 2,10,000 into what is the percentage? 10 divided by 100. So I'll get 21,000. That is increase in asset. Next one is outstanding audit fees. I have already told you outstanding audit fees is liability. Increase in liability, where do we record? That is increase in liability. We'll record in the debit side to outstanding audit fees 1,000. Now as usual, we'll balance both the side and the balancing figure will be either revaluation profit or revaluation loss. Now here if you see credit side is 21,000 whereas debit side you will get a balancing figure of 12,780. So how to calculate that? So 21,000 minus 1,000 minus 2,400 minus 3,500 minus 1,320 will get a balancing figure of 12,780. So your credit side was more than your debit side, right? It means what? It is revaluation profit. So that profit has to be transferred to old partners capital account. In which ratio? Old ratio. So what is their old ratio? That is 2:1. In this ratio, it has to be transferred. So transfer, who are the partners? Right? To profit transfer to partners capital account. Who are the partners? Raga and Tala. What is the profit? 12,780 into 2 divided by 3. We'll get 8,520 and 4,260. If you divide into 1:1 ratio. So this is about revaluation account. Now moving on to the next account, that is partners capital account. So as you know, partners capital account, what is the format? You will be having both debit and credit side. Under debit side particulars and we will draw column for each partner including new partner. So here who are the partners? Raga, Tala and Shruti. In the same way credit side also. So first we will bring down the capital of the partners. So bring down the capital. So capital of old partners which is given in the balance sheet as by balance brought down. Now go through the balance sheet. They have given the capital 1,20,000 and 80,000. So take that capital as by balance brought down. So by balance brought down 1,20,000 and 80,000. Next you have already prepared the revaluation account. So we got, so what is the balancing figure of revaluation account? This revaluation profit. So transfer this profit to partners capital account. So how to record? By revaluation account. So by revaluation account, so it is profit. So how much each partner will get? 8,520 and 4,260. Next, check your balance sheet whether there is any reserve, fund as well as profit and loss account. So go through the balance sheet here. So in the liability side, check whether there is any reserves, fund as well as profit and loss account. Of course, we have 42,000 as general reserve and 18,000 as profit and loss account. So transfer these two to old partners, only to the old partners. In which ratio? Old ratio. Now, why it has to be transferred only to the old partners? Because this reserve profit and loss account belongs to old partners. New partner have not earned in order to earn this profit, right? So it has to be distributed only to the old partners. In which ratio? Old ratio. So how to record? By general reserve. Reserve is 42,000. Distribute in 2:1 ratio. That is 28,000 and 14,000. In the same way, profit and loss account 18,000 into 2:1. So I'll get 12,000 and 6,000. Now we are done with all the transactions relating to the old partners. Now come to the new partner. What has new partner has bought? New partner has bought capital as well as goodwill, right? So go through the question here. She has bought 80,000 as capital and 42,000 as goodwill. Add both and transfer to bank account. So how to write? By bank account 80,000 plus 42,000, write in new partners column 1,22,000. That is capital as well as goodwill which is bought by the new partner. Now we have to record goodwill entry as per accounting standard 26. Now what is the entry as per accounting standard 26? For treatment of goodwill, that is, new partners capital account data to old partners capital account. Now, who is the new partner here? Shruti. So, by Shruti's capital account, to old partners, to Raga's capital account and to Tala's capital account. That is nothing but new partners capital account data to old partners capital account. Hope you are clear with this. Now, the new partner is Shruti. Old partners are Raga and Tala. Now, you have to distribute the goodwill which is bought by the new partner. So, how much goodwill is bought by the new partner? 42,000. Distribute that goodwill in sacrifice ratio. Now, in this question, we have only old ratio. We don't have any other information. So, we cannot calculate the sacrifice ratio. So, old ratio itself is considered as sacrifice ratio here. So, distribute this goodwill. 42,000 into 2:1. It is the old ratio. So, normally the goodwill has to be distributed in sacrifice ratio. Since we don't have sufficient information, so old ratio itself is considered as sacrifice ratio. So, 42,000 into 2:1. Write amount in old partners column. So, Raga will get 28,000, Tala will get 14,000 if you distribute that 42,000 in 2:1 ratio. And the next part of the entry is the same, that is to Raga's capital account to, this is not Shruti, this is Tala's capital account. So, these are the old partners. Now, here, how much amount to be given to Raga? 28,000. What is the amount to be given to Tala? 14,000. Now we are done with this. Balance both the side and the balancing figure will be transferred or it will be carried down. The balancing figure has to be carried down and it has to be written as capital in the balance sheet. So it will be transferred. So this balance will be transferred to balance sheet. So hope you know how you have to balance, right? So same as your ledger account, you have to balance each column. So you have to take individual partner and you have to balance both the side. And the balancing figure will be transferred or it has to be carried down and that will be recorded in the balance sheet as a capital of the partner. So whatever the amount you have carried down, bring down that balance as by balance brought down same amount, that is 1,96,520, 1,18,260 as well as 80,000. Now we shall go through the bank account. Now, bank account is very simple. As I told you, it's an optional here. So, you need not prepare bank account. If they ask, you have to prepare or else you can directly go through the balance sheet. Now, so first bring down the balance of bank account. So, your format remains same. You will be having debit as well as credit side. Under debit side, particulars, amount. Under credit side also, particulars and amount. Now, first bring the balance of bank account. So, if you go through the balance sheet, that is in the asset side, so you will have cash at bank. How much? 19,800. So take that balance. Take that balance as to balance brought down in the debit side of bank account. Now go through bank account. So to balance brought down 19,800. 800. Next, what we have done here, we have transferred the capital as well as goodwill of the partners to new partners capital account, that is Shruti. So how do you record? To Shruti's capital account. So how much? That is amount is 1,22,000. So to Shruti's capital account 1,22,000. Now we are done with this. Balance both the side and the balancing figure will be transferred, or it has to be carried down and it has to be shown in the balance sheet. So the balance amount is how much? 1,41,800. So this is the balance. Whatever the amount you have carried down, you have to bring down that balance as to balance brought down. Now the last statement to be prepared is balance sheet, and we have to prepare balance sheet on which date? On the date of admission of a partner. So here also your balance sheet remains same, your format remains same. We will be having liabilities, amount, asset and amount. Now we will go through the old balance sheet which is given in the question, see one by one, and if there is any adjustment we have to make the adjustment, or else we shall write the same amount what is there in the old balance sheet. Now we shall go through old balance sheet here. So first one is cash at bank. So we had already prepared the bank account, right? So we can directly write what is the balancing figure of bank account. So balancing figure of bank account is 1,41,800. Write the same amount. So if you want to, if you are not preparing the bank account, you can calculate here. Now 19,800 is a bank balance which is given in the balance sheet, plus 80,000 is a capital which is bought by the new partner, and 42,000 is a goodwill which is bought by the new partner. Add all these and write in the outer column, that is 1,41,800. If you are preparing bank account, no need to calculate all this. You can directly write the balancing figure of bank account. And the next one is what? That is debtors 22,000, but there is a reserve, right? We had already calculated 1,320. So deduct that reserve. So debtors 22,000 less the reserve, how much? 1,320. Outer column 20,680. And the next one is stock 60,000, but I think there is a depreciation. Yes, depreciation of 2,400 on stock. So we have to deduct that. So 60,000 less depreciation, you'll get 57,600. And the next one is machinery 70,000. And let us see whether there is any. Yes, there is a depreciation on machinery at 5%, and we had already recorded in the revaluation account. Machinery depreciation is 3,500. So deduct that depreciation. So machinery 70,000 less depreciation 3,500, you will get 66,500. Next, moving on to the next one, we have land and building 2,10,000, but there is a appreciation. If you see the adjustment, there is a appreciation of 10% of 2,100. So add that appreciation. We had already recorded, that is 21,000, now 2,100, 21,000. We have already recorded in revaluation account once. Now we have to add in the balance sheet. So land and building 2,10,000, add 21,000. So the total is 2,31,000. Now come to the liability side. We are done with all the assets. Now come to the liabilities. So which is the first liability here? Creditors 78,800. But there was no adjustment relating to creditors. And the same way loan also, there was no other adjustment. So take this both in the same amount what they have given in the balance sheet. It means that the value remains same. So creditor 78,800, loan 43,000. Next, what they have given? They have given general reserve and profit and loss account. We had already distributed in partners capital account. And the capital also we had already taken in partners capital account. Now instead of this capital, we have to record the balancing figure of partners capital account as capital. Before that, there is a outstanding fees. Right, outstanding audit fees. How much? 1,000. So it is what? It's a liability. So we have to record in the liability side of the balance sheet. So outstanding audit fees 1,000. Now write the capital. What is the balancing figure of partners capital account? So these amount has to be written as capital. So record all the amount as capital, total it, now balance both the side, and the total of liability side should be equal to total of asset side. So this is a very important 15 marks problem on admission of a partner. Now we shall go through next one, that is retirement of a partner. So admission is nothing but if a partner enters into an existing partnership firm, it is called as admission of a partner. Then what do you mean by retirement? If a partner leaves the existing partnership firm, then it is called as what? Retirement of a partner. Now go through here. When one or more partners leaves the firm and the remaining partner continue to do the business of the firm, is called as retirement of a partner. Hope you are clear with the meaning. For example, if X, Y and Z are partners, now Y is going to leave the partnership firm. So what it is called as? It is called as retirement of a partner. If one or more partners leaves the existing partnership firm, it's called as retirement of a partner. Now we shall go through a problem on retirement of a partner, same as your admission. Here they will give the question, they will give the balance sheet before the retirement of a partner. So here also they have given certain assets here and they have given certain liabilities. Next they have given certain adjustment. Now what is the difference is that now yes, of course there is a increase or decrease in the value of assets and liabilities. So here there is increase in asset, building has stock has decreased, so decrease in asset. Next, reserve, so there is an increase in liability. Next, goodwill of the firm is valued at rupees 90,000 they have given. Now same as your admission chapter or admission topic, so here also you are going to prepare revaluation account, partners capital account as well as balance sheet. But in revaluation account, see the revaluation account, of course we'll record the heading revaluation account, we will record the entries. What you are going to record in the debit side? Same as your admission, A minus L plus, whereas here also A plus and L minus. Now here what you are going to record? So you will record increase or decrease in the value of assets and liability. So if any assets have decreased and liability have increased, you are going to record in the debit side. Whereas in the credit side, if any assets have increased and liability have decreased, you are going to record in the credit side. Now here also machinery have decreased, right? So here they have given machinery have decreased. So where do you record? In the debit side. You will record the value. So value is 27,000 into 5%. So you will get 1,350. In the same way, stock have decreased. So stock also decreased by 5%. So you will record stock 3,300. Value into percentage. In the same way, here also building have appreciated. So where do you record? In the credit side. So when you calculate, you will get 12,000. Next, what they have given? Increase in liability. You will record in the debit side. That is to reserve for bad debts, 2,700. Next, goodwill will take in partners capital account. Now, we will balance both the side and the balancing figure will be either revaluation profit or revaluation loss. Now, here you have to remember, in the admission, you are going to transfer only to the old partners. But here, you have to transfer this revaluation profit or revaluation loss to all the partners. In which ratio? In old ratio, you have to transfer to all the partners. That is A, B and C, including retiring partner also. So, this is about your revaluation account. The only difference is here. That is distribution of revaluation profit or revaluation loss. Next is partners capital account. So here also first we will take down the capital of all the partners. So capital of all the partner as by balance brought down. Next you will transfer the revaluation balance. It may be either profit or loss. So if it is loss, you will record in the debit side. If it is profit, you will record in the credit side. That is revaluation account. Next, we will check whether there is any reserve fund as well as profit and loss account. Now, if you see the balance sheet, there is reserve. So, we will transfer this reserve to all the partners. Whereas in admission, we will transfer only to the old partners. Right? So, here you will transfer to all the partners. That is all three partners in which ratio? In the old ratio. Next, See your balance sheet once again. Here we have profit and loss account. So this profit and loss account will be transferred to debit side of partners capital account, and it has to be transferred to all the partners in old ratio. So how to record? To profit and loss account, transfer this profit and loss account to all the partners. Next, your entry will be, that is, you have to go through the treatment of goodwill, right? So your entry will be remaining partners capital account data to retiring partners capital account. Whereas in admission, your entry is new partners capital account data to old partners capital account. So here what you are going to do, you are going to record it as remaining partners capital account data to retiring partner capital account. Now here A and C are remaining partner and retiring partner is B. Hope you are clear with the entry. To A's, by A's capital account, by C's capital account, to B's capital account. Now how to calculate the goodwill? So they have given the valued goodwill, right? So 90,000 is a valued goodwill. Now we have to take the share of retiring partner. Now who is a retiring partner? B is a retiring partner. So what is your profit sharing ratio? 2:1. So this is of A, B and C. So in the sense 2/5. So this is the share of B. Right? Now we have to take the share of B, 2/5. So we'll get 36,000. That is 90,000 is a valued goodwill into share of B. That is 2/5. You get 36,000. Now this 36,000 has to be distributed in gain ratio. Now what is a gain ratio? They have not given any information. Now leave the share of B. What is the remaining share? 2:1. So this has to be distributed in 2:1 ratio. So this is about retirement. So if they have given valued goodwill, first take the retiring partner share of goodwill and that amount has to be distributed in gain ratio. That is, if gain ratio is not given, then take the retiring partner share, the remaining share itself is the gain ratio. Now go through the solution here. Yes, 36,000 we got, distribute in 2:1 ratio, but write in retiring partners column 24,000 and 12,000. The next part of the entry is what? To retiring partners capital account, write in A's column and C's column. Now here the difference is that the balancing figure, what you used to do in admission of a partner, you will carry down that balance. Now here be careful. So here retiring partners balancing figure has to be transferred to his loan account. Now the retiring partner is B, right? So if you balance, you'll get a balancing figure of B is 93,660. Transfer that amount to his loan account. Okay? Whereas other partner, that is remaining partner is A and C, their balancing figure has to be carried on because they are going to continue in the future, right? So here retiring partners amount has to be transferred to his loan account, whereas remaining partners capital has to be carried down. So whatever the amount you have carried down here, that is remaining partners capital, so it has to be brought down once again, 45,660 and 28,830. Now come through the balance sheet. So balance sheet remains same. Okay. So you will record cash at bank. So your cash at bank does not differ because here new partner. So there is no entry of new partner, right? So your cash at bank will remain as that of the old balance sheet, and debtors. So there is a reserve. So deduct that, you will get 42,300. In the same way, stock 66,000. There was a depreciation. So deduct that depreciation, you will get 62,700. In the same way, machinery 27,000 less depreciation, you will get 1,350. That is 25,650. Next, furniture, there was no changes in furniture. There was no appreciation or depreciation which is given in the adjustment. It means that it remains same, 7,500. Next, a building, there was a appreciation. So add that appreciation, you'll get 72,000. Now coming to the liabilities here, there is a few changes under B is low. Okay, so bills payable, so there was no changes. So these are the items which is taken in the old balance sheet. Okay, same as admission. Next, creditors also 25,500. Next, there was an outstanding salary where that is in the adjustment. So we have taken 4,500. Next, B is a loan. Now, The balancing figure is B's loan. So the balancing figure of B has been transferred to his loan account, right? So that has to be taken as B's loan 93,660. Then the capital is that of A and C, that is a continuing partner. So here we have carried down that amount. So take that amount as usual as capital. So capital 74,490 of both the partner. Now balance both liability and asset, and it should be equal. It is 2,16,150 in both assets and liability side. So here, as I told you, you have to be careful in transferring the revaluation profit or revaluation loss, where you have to transfer to all the partners. In partners capital account, if there is any reserve fund or profit and loss account, it has to be transferred to all the partners. And in the balance sheet also, there is a slight difference where you have to take this retiring partners loan account. Other than that, everything will be same as admission of a partner. Next, we shall go through, that is a 5 marks question may be asked on sacrifice ratio. So you know about sacrifice ratio. We are going to calculate on admission of a partner. Let us see what is this sacrifice ratio. The ratio in which old partners agree to share their profit in favor of new partner is called as sacrifice ratio. So as you know, when a new partner enters into an existing partnership firm, so this old partner will sacrifice their share of profit, right? So on which ratio they are going to sacrifice? So that ratio is called as what? Sacrifice ratio. Now there is a formula here, old share minus new share is equal to sacrifice share or sacrifice ratio. Now why the sacrifice ratio is calculated? In order to distribute the goodwill which is bought by the new partner. So you know, when a new partner enters into a partnership firm, he or she will bring certain amount as capital and some extra amount will be bought by the new partner in the form of goodwill. So in order to distribute that goodwill, so new partner will bring some extra amount which is called as goodwill. So in order to distribute this goodwill among the old partners, so this sacrifice ratio is calculated. So this is about sacrifice ratio. Now we shall go through the partnership deed. It is also one of the important question for 5 marks. Now what do I mean by partnership deed? So my dear students, you know, in partnership there should be an agreement between the partners, right? So that agreement can be either written agreement or oral agreement. So it can be either written agreement or oral agreement, but written agreement is more preferable than oral agreement. Why written agreement is more preferable than oral agreement? Because this written agreement always acts as a evidence. So rather than oral agreement, written agreement is more preferable. So now what is this partnership deed? The document which contains terms and conditions regarding the conduct of partnership firm is called as partnership deed. So that written agreement which contains all the terms and conditions of the partnership firm is called as what? Partnership deed. Let us see what are the contents to be included under partnership deed. So it contains each and every. So as I told, it contains all the terms and conditions, right? So let us see what are the contents to be included. So the first one is name and address of the firm. And the next one is name and address of the partners, type and nature of the business, whether it is a manufacturing business or trading business. So that has to be mentioned. Amount of capital, of course each and every partner has to contribute the capital. So what is the amount of capital which is contributed by each and every partner will be recorded in the partnership deed. Next, interest on capital, drawings, interest on drawings, profit sharing ratio, what is the salary of partners, goodwill of the partnership firm. Next, accounting period. So for how many years they are going to continue the business. So that will be recorded. Next, method of recording firm's account. So in which method they are maintaining the firm's account. Next, auditing. So how the auditing is being conducted. Date of commencement of partnership. So when did the partnership start? Duration of partnership. What is the total duration of the partnership? It may be 10 years, 20 years or 5 years. So that duration has to be mentioned. Next, what are the bank accounts? So how they are going to maintain their bank accounts. Next, rules to be followed in admission of a partner. So when a new partner enters, what are the rules to be followed? Next, rules to be followed while settling the accounts on retirement. Suppose if a partner retires, so how his account has to be settled? So that has to be mentioned in partnership deed. Next, rules to be followed while settling the accounts on dissolution of partnership firm. Now, what do you mean by dissolution of partnership firm? Closing down of partnership firm is called as dissolution of partnership firm. So, what are the procedures as well as rules to be followed? Next, settlement of disputes. So, if there is any complications between the partner itself, so how it has to be solved? So, how the disputes has to be settled? So, each and everything will be mentioned in the partnership deed. Now we shall go through the next concept, that is dissolution of partnership firm. So my dear students, here you have to remember dissolution of partnership firm is nothing but closing down of partnership firm. So that is known as what? Dissolution of partnership firm, or the partnership firm comes to an end is called as dissolution of partnership firm. So this is your 6th unit, that is last unit. So dissolution of partnership firm means firm closes down its business and comes to an end. So I have already told you, here the firm comes to an end is called as dissolution of partnership firm. On the dissolution of the firm, the assets of the firm are sold. Now what they will do on the dissolution? By selling the asset, they will get the cash, and using that cash, they will make payment to the liabilities. So on the dissolution of the firm, the assets of the firm are sold and liabilities are paid off, and out of the remaining amount, the accounts of the partners are settled. So what they will do? They will sell the assets and they will make the payment to liabilities. So they will make the payment to liabilities. After making payment to liabilities, so if any amount is left, so it will be distributed among the partners. So it will be distributed among the partners in their profit sharing ratio. So this is about dissolution of partnership firm. Now we shall go through a 15 marks important problem on dissolution of partnership firm. As I told, it comes for 15 marks. Now go through the problem here. Prashant, Praveen and Prakash are partners sharing profit and loss in the ratio 3:2:1. Hope you are clear with this. Who are the partners here? Prashant, Praveen and Prakash, and they have given their profit sharing ratio 3:2:1. And they have given the balance sheet here. They have given certain liabilities like creditors, loan from Prashant. Now here you have to be careful. Here a partner itself have provided the loan, so we have to prepare partner's loan account. Next, they have given reserve fund, bills payable, then they have given the capital of the partners. Okay, coming to the asset side, we have bank, debtors, stock, plant and machinery, profit and loss account, then goodwill. How much? 18,000. Next, what they have given, on the above date, they decided to dissolve the firm. That is, before the closing down of the business, they have given the balance sheet. Now they have decided to dissolve or close the partnership firm. And the assets were realized as follows. They have sold certain assets like debtors were sold at rupees 28,000, plant and machinery at rupees 60,000, and stock was taken over by Prakash. Now, certain assets have been sold and certain assets have been taken over by the partners itself. Now, stock was taken over by Prashant at rupees 36,000 and creditors and bills payable were paid in full. So, they have paid all the liabilities. Realization expenses amounting to rupees 3,000. Now, what do I mean by realization expenses? During the process of dissolution of partnership firm, they will incur certain expenses which is called as dissolution expenses. So, what is the dissolution expenses here? That is rupees 3,000. Prepare necessary ledger accounts. Now, here, which are the accounts to be prepared? That is realization account, partners capital account, partners capital account, partners loan account, and bank account. Now, since the partner have provided the loan, we have to prepare partner's loan account, and here be careful. Revaluation account is prepared during admission, retirement and death of a partner, whereas realization account is prepared during dissolution of partnership firm. So these are the accounts we have to prepare. Now we shall directly move through the solution. Now how we are going to prepare the realization account? First, bring down all the assets except cash or bank and profit and loss account. So except these two items. So which are the two items? Profit and loss account or cash and bank. So we have to bring all the assets which is given in the balance sheet. Now go through the assets here. So bank we are not going to take, debtors, stock, plant and machinery, and we are not going to take this profit and loss account. We have to take the goodwill. So take all the assets except cash or bank and profit and loss account. So we have to take all the assets together. So this is your first step. Debtors, stock, plant and machinery and goodwill. That is in the debit side of realization account. Next, your second step is that take all the liabilities except reserve, fund, profit and loss account, partners loan as well as partners capital. Except these 5 items, we have to take all the liabilities. So which are the liabilities which should not be taken? That is reserve, fund, profit and loss account, partners capital as well as partners loan. Now go through the liabilities here. So we have to take creditors. This is partners loan because Prashant is a partner. So we are not going to take. Reserve fund we are not going to take. Bills payable we have to take. Capital we are not going to take. So take all the liabilities. So only 2 liabilities, creditors and bills payable. This is your second step. Now your third step is that you have to sell the assets which is given in the adjustment. So here they have given debtors 28,000, plant and machinery how much? 60,000. So record that. So how to record? By bank account assets realized, debtors 28, plant and machinery 60. But they have not given any information of goodwill. So we shall assume that goodwill is also being sold at its original value. Now what is the original value? 18,000. So write 18,000 right in the outer column. Next, what you have to record? Using this cash, we have to make payment to the liabilities. Now, what they have told about liability, creditors and bills payable were paid in full. So, how to record? 2 bank account liabilities paid. So, which are the liability? Creditors and bills payable. It is 78,000 and 12,000. So, the total is 90,000. So, we are done with this. Now, we have paid the liabilities. Now, see whether any asset is taken over by the partner. Stock is taken over by Prashant at rupees 36,000 and creditors and bills payable were paid in full. So, here only one stock is taken over by Prashant. How much? 36,000. So, how to write? By Prashant's capital account, asset taken over 36,000. Suppose if any liabilities is taken over, we will record in the debit side. Whereas here, only one asset is taken over, that is stock is taken over. So, we will record in the credit side of realization account. Next, record dissolution expenses. So, here they have given dissolution expenses 3,000. So, how to record? 2 bank account, dissolution expenses 3,000. Now, balance both the side and the balancing figure will be either realization profit or realization loss. Now, in this problem, it is realization loss. So, transfer this loss to all the partners in their old profit sharing ratio. Now, who are the partners? Prashant, Praveen and Prakash. What is their profit sharing ratio? 3:2:1. So, distribute in this ratio, that is loss. So, loss is 38,000. Suppose it is profit, you will record in the debit side of realization account. Now we are done with realization account. So what are the steps to be remembered? First we will record all the assets except cash or bank and profit and loss account. Next take all the liabilities except reserve, fund, profit and loss account, partners capital as well as partners loan. Next sell the assets. In the adjustment itself, they will give assets realized. So take that and record in the original amount or the amount which they have given in the adjustment. Next, make the payment to liabilities. So here they have told both the liabilities have paid in full. Next, record if any asset is taken over in the credit side or record that partner's capital account. Next, write the dissolution expenses. Balance both the side and the balancing figure will be either realization profit or realization loss. So this is about realization account. Next, partners capital account is very easy. Same as your admission and retirement. You will be having debit as well as credit side. First, you will take the balance. That is capital balance of the partner which is given in the balance sheet. Now, who are the partners here? Prashant, Praveen and Prakash, and they have given the capital. So, take the capital of these partner as by balance brought down. So, by balance brought down 60,000, 30,000 and 6,000. Next, check whether there is any reserve, fund and profit and loss account. If you find, you have to distribute to all the partners. In the liability side, there is a reserve. So, 24,000 distribute, then in profit sharing ratio 3:2:1, you will get 12,000, 8,000 and 4,000. Next, what you will do? So, next you will record the realization loss. So, here we had a realization loss. So, transfer that loss. So, 12,000, 19,000, 12,667 and 6,333. That is a realization loss. Next, check your debit side whether any of the account has been transferred to partners capital account. Now, here if you see, there is no other account. If you see the credit side, yes, of course, there is a account which is being transferred or amount which is being transferred to Prashant's capital account. So, how do you record the reverse entry? To realization account. So, how do you record? To realization account, that is 36,000. And in the balance sheet also, there is a profit and loss account, that is in the asset side. Transfer that profit and loss account to the debit side of your realization account. That is 36,000, 24,000 and 12,000. Next, we have recorded for asset taken over. Now, balance both the side and the balancing figure will be transferred to bank account. So, where the balancing figure has to be transferred? So, here the balancing figure of Prashant as well as Prakash will be transferred to bank account, that is in the credit side. In the same way, debit side also, the balancing figure of Praveen will be transferred. So, here the balancing figure might be in the debit or credit side, but both the amount has to be transferred to bank account. So, it may be in the debit side or it may be in the credit side. So, this is about your partner's capital account. Next, partner's loan account. Of course, Prashant have provided loan. So, if you see the balance sheet, here they have given loan from Prashant 45,000. So, that amount has to be paid to him back, right? So, we shall prepare partner's loan account. So, first take it as by balance brought down 30,000 is the loan, not 30,000. So, it is Prashant's loan is 45,000. So, this is 45,000. So, take it as by balance brought down. Now, make payment or a payment of that loan, that is same 45,000. Balance both the side, your balance will be same 45,000. So, this is about partner's loan account. First, bring down the balance in the credit side. By balance brought down 45,000 and transfer to bank account, that is 45,000. Next, last account to be prepared is bank account. So, if you are familiar with realization account, partner's capital account and partner's loan account, it's very easy to prepare the bank account. Now, first take the balance of your bank account. Now, if you see the asset side, so they have given bank, how much? 6,000. So, take this balance as to balance brought down 6,000. Okay. Now, go through the realization account first. See any of the amount which is been transferred to bank account. Yes, here there is the amount. So, how do you record the reverse entry? That is, the total amount is 1,06,000 is been transferred to bank account. So, how to record the reverse entry? To realization account for assets realized. So, we'll record in the bank account to realization account. So, to realization account 1,06,000. Now, go through the next one. So, here under realization account, no other amount which is been transferred to bank account. Now, come to the debit side. So, debit side, here we have an amount that is for expenses or liabilities paid. How much? To bank account, how much? 90,000. So, how do you record in your bank account? By realization account. By realization account, liabilities paid 90,000. Next, we have for dissolution expenses. Here also you'll write it as by realization account, that is 3,000. That is for dissolution expenses, 3,000. Next, we are done with realization account. There is no other bank account. Now come to partners capital account. Here we have bank account, right? So how do we record? To Prashant's capital account, to Prakash capital account. How much? 19,000 and 8,333. To Prashant's capital account as well as to Prakash capital account. So we have done with this. Next, here also in the debit side we have two bank account. So how do we record? By Praveen's capital account. So by Praveen's capital account 1,333. Next we have loan also. So coming to loan account. So how do we record? By Prashant's loan account. By Prashant's loan account 45,000. Now balance both the side and the total of debit side should be equal to total of credit side. That is 1,39,333. So here you are going to just reverse the entry and record in your bank account. So as I told, if you are familiar with realization account, partners capital account and partners loan account, it's very easy to prepare the bank account. My dear students, we had a quick revision on financial accounting 2 from unit 4 to unit 6. So if you have any doubt, you can go through the sessions and watch. There have explained you clearly. So my dear students, see you all in my next session. Till then, take care. Thank you.